All right. Good morning, everybody. So we're on the other side, and now we're focusing on what's next. We're still looking for the change, the behavior in the market, where right now we're in bad news is good and good news is bad. And that still needs to change. It's one of the easiest things for even new traders to pay attention to when they're trying to figure out what to do with their longer term holdings. Everybody's focused on the Fed and when we're going to get a rate cut or if we're going to get a cut. It really seems to be that they're not going to cut until something breaks and they have to cut. They're forced to cut. And that's the way it was all the way back into last year until around November, December, when Powell kind of dropped those hints that they might do a possible cut on GP, general principles, just putting a cut in there somewhere. The market loved it, really fought against onto it, priced it into the market, and then they took that back. So the market had to readjust to the idea that there wouldn't be a general principle rate cut, just a GP cut. And now it's back to we're not going to cut unless something breaks. If you notice those subtle headlines of various companies laying people off, those are the canaries in the coal mine. And a lot of Joe Schmo name companies that aren't really popular or really big also laying people off but aren't getting the headlines behind it. So when you see Microsoft, Google, Meta, when they're laying people off, of course, they're the big name headliners. They're going to make the news. Those smaller companies oftentimes are not. So how long before something breaks is kind of the question. And right now, this morning, taking a look at what's going on around the world, small caps are down 0.5%. Hong Kong right behind it. The Dow about 0.25%. Japan is flat. They're going to do a rate decision tonight, so that's something to really be paying attention to. S&P basically flat, and the Nasdaq up more than 0.5%. That divergence right there between the S&P and the Nasdaq, look at that and consider which one is going to play catch up. Is the Nasdaq going to drop back down to basically flat on the day, or is the S&P going to rally up and match the Nasdaq? These two don't have to be perfectly in sync, but you'll notice a lot of times that if the Nasdaq is up 0.5%, then the S&P is up 0.5%. If one is down, 1.25%, so is the other. So when they're this far out of line, it's worth taking a look at to see when or if they're going to normalize. And they don't have to normalize today. I just want to put that out there. They can stay divergent all day. But it's a really nice tell as something to keep your eye on if one side, say the Nasdaq starts to drop and we're, looking for a bearish play. Target would be taking the Nasdaq, you know, through VWAP, through the low of the Globex, and then getting back towards the Globex open and level by level till it matches the S&P. So it's just a simple thing to keep your eye on. Someone said the volume's low. Anybody else having volume issues, let me know. Shouldn't be. I didn't change anything. And my mic isn't on my head. That's usually when the volume is off. I forgot to, forget to bring the mic down. We're going to get some jobs data this morning and then PPI, and we have the 30-year bond. And make no mistake about it, the 30-year isn't my sweetheart. I like the 10-year better, but the 30-year as a big, we're going to feel it. I say that, but it could be a dud. We've seen plenty of times where we've gotten 30-year auctions and it was nothing. I just kind of got the feeling today ain't going to be nothing. So watch the clock. 30-year comes in at 1. Could be a significant change on the day. We're also no longer in blackout mode, so very likely going to get more than just Williams. Could get a number of Fed speakers out there chipping teeth, and then that rate decision that I was mentioning. Yellen is going to be out there as well at noon. I know it says 11, but Finance Juice is looking at my time zone, not market time. So we have Yellen today also. I think we're going to fill that 30-year bond today. That's going to be, I think the 30-year bond is going to be bigger than PPI today. How about that? Gold down 1.25, crude down more than 0.75%, not quite a full percent yet. We're nearly to the central pivot this morning, the floor pivot. And we are really in the middle of nowhere when we think about the ADR levels. The pivot for today is completely outside the range of the pivot from yesterday. The channels aren't overlapping at all, and we're hugging pretty close to where the pivot is at. Not much distance or difference there. We always focus on how far away we are from the 10-day. It's a way to gauge if we've moved too far, too fast, and if we're due some sort of pullback, mean reversion. And I have an indicator for this. We look at it every day. But we don't always look at it in the context of actually seeing it on the chart. I use the lower indicator that quantifies the distance of how far away we are. When we get, quote, too far, really two choices at that point. The market can pause, go sideways, and wait for the 10 to come up and meet us, or turn around and go back towards the 10. Those really the two choices. One of the things that I like to do is put some levels on yesterday's price action. I would also put levels on a very big candle. So two different reasons to do what I just did here. Mark the high, the low, and the midpoint. We would do that on a big candle, and we would also do that just on yesterday's price. We want to see this. We want to see price stay above this midpoint. The call wall did not get moved yesterday, last night. I'm still waiting on Spot Gamma to put out the AM edition, which they haven't done yet, but the call wall is still at 5408, so we're above it. If they had rolled it yesterday, it would have been viewed as a bullish sentiment or a bullish behavior. And the fact that they didn't roll it, I don't want to read too much into that yet. but I'm not reading that as bearish. It's just not bullish. Because everything happened late in the day yesterday, it's possible that they're going to roll that call wall today instead. But we do want to be thinking about options expiration. It's the third Friday of the month, and that's next week. It's also going to be when we change off of the futures contracts. So the idea is, are they going to roll it if it's going to expire in a week? Now, they might start rolling early, focusing on next month's options when they do roll and doing both at the same time, right? Getting out of the June options, going into July, and rolling up or down. It will be considered bullish if they roll it up. It will be considered bearish if at the end of the day today, it still hasn't moved. I'm going to take that as a bearish sentiment. But we'll see what Spot Gamma says. Maybe they'll have some insight into this. Volume's looking good at 84, and we don't see any hedging activity. So even after that really big move, doesn't seem like there's any fear or concern. $10-day, 30-minute volume profile with TPO. There's no reason to suspect that we're going to move this point of control anytime soon. The only thing that would cause this to move at this point would be if we get an exceptional amount of volume across this high. You know, sometimes we look to see the point of control move because we're going to lose candles on the left side. But the candles that gave us the point of control are right here. And it's going to take until next week into next Thursday before we really start seeing a significant change in these candles here. So the only way we're going to move this point of control is if we build up a lot more volume here across these highs. That would be significant too when we think about a profile, whether it, you know, a classic B, or maybe at that point we just have a classic D. With a point of control across the top side of that D shape. The concern is we're going to build up a high volume node up here, and then it's going to act as a resistance, and we'll have a hard time cutting through it and getting even higher, getting into that 5,600. We don't have a point of control to carry forward since we've already hit it. Now, there's two arguments to make on this. I don't want to carry it forward because it's already been hit. And I haven't said what I'm about to say in a while, so it's just good to repeat this from time to time. If you was to study volume profile, you know, go in and read some books on it or something like that, what they'll tell you is to carry forward these lines every day. Always look at yesterday's volume profile and mark out where the point of control is, where the value area high is, and where the value area low is. They tell you to do that because when price gets to these levels, it very often has a reaction. If we get near those levels, price will often gravitate to it, be pulled to it. It's where the liquidity was. Now I've got more than enough pivots, so I don't need to mark those lines out every day. And the only point of control that I carry forward is ones that haven't been hit. So, this example down here on Tuesday, we built the point of control in the middle of this zone, and price closed way up here. It hasn't come back and hit that line, so I keep that line on the chart. I wouldn't want to do that for Monday because we opened in the Globex and dropped right down and hit that level. Price crossed through that level multiple times in the overnight, so it's no longer an untouched point of control. It's been touched frequently. So I'm only carrying forward the untouched points of control. But that doesn't mean you shouldn't, or that that you wouldn't want to. If you don't have enough pivots and you want to add something, this would be a good add. Even if you are only carrying the untouched points of control, there's a lot of arguments that say if it was hit in the Globex and we didn't say close above it and keep going, that it's worth marking it on the chart because it might still represent a lot of unfinished business. Think about what the point of control is to begin with. It's where the greatest amount of volume happened in the previous day's session. So right here at this 54.42, that's where the greatest amount of volume took place. Consider it from your own point of view. If yesterday you got into a position at this point, and here we are the next day, right back where you got in, you may reconsider your position. Maybe you'll decide to get out, or you'll decide to double down. We don't need to make assumptions really about what they're going to do. We just need to make the assumption that if that's where the greatest amount of volume was, when we get back to that spot, there's very likely going to be trading activity again. We'll see a spike in flows. We'll see activity on the dome. We could see a reversal or a rejection or some behavior where we can play that as a trade. And since we haven't technically cleared that level out yet, we don't know if there's still a lot of traders sitting at this level. So it might be worth marking it on your chart. Even if it has been touched, we haven't necessarily, broke through it and cleared it out. Just think about the liquidity that could be there. These rules are, adjustable per person. You can do what you want. The main thing is to stay consistent in your approach. If you carry it forward every day, no matter what, then carry it forward every day, no matter what. If you take it off after it's been hit, then take it off after it's been hit. Really, you can do it however you want. Just try to stay consistent with it. There are times where I leave it on after it's been hit. When I do, I just change things so that it's no longer a VPOC. Now it's just an area of interest. That way it's at least on my screen, it's on my radar. I can pay attention to that level when we come up into it, but I won't treat it as an untouched point of control. All right, this is the weekly expected move. And the range that I had drawn on Monday for what we were expecting price to do into FOMC held perfectly. Now, once we got into FOMC, then we blew that right out of the water. So we don't need that anymore. But that was the range that we had anticipated price to stay in until we got to POW. Now we're completely outside of the entire trading week. This range is how far price was supposed to go up or down, but also the range that price was supposed to close in by the end of the week. There was an 80% chance that price would close inside this box. Now that number throws people off. because it's not a 1 standard deviation and it's not a 2 standard deviation. I get to that number because I know the ES, I know the NASDAQ, I know, the IWM. I study these guys like crazy. It's what I do. It's what I play. It's what I trade. The S&P has a very accurate expected move model. It's one of the most accurate expected moves that you could ever come across. And that's because for years, it had 3 expirations when everybody else had a weekly expiration of 1, Friday. The S&P had 3, Monday, Wednesday, and Friday for years. So it was getting way more trading activity than any other weekly. And expected move is based on trading activity. The more trading there is, the more data you have to calculate your expected moves. So the more accurate it is. Then it was the first one to get 5 expirations a week. This model is the most accurate expected move model that you can get, is the S&P. And instead of doing a 1 standard deviation, it tends to close inside of that, not 68 point blah, 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 whatever the 1 standard is. It tends to close inside that box 80% of the time historically. If you just go back and count, it closes inside the box 80% of the time. Now, I don't want to count 50 to 100 weeks. So I just run a little shortcut and I count 10 weeks. How many times on Friday at the close has this thing been outside the box? Generally, you'll count less than 3, right? That's 2. Less than 3 out of 10, and there's your 80%. When that number drops, it gets my attention. We can close outside the box once in a while. That's not a big deal. Once in a while, it's fine. But when you get repeated closes outside the box, when we go into the close on Friday and we're outside of the box again and again and again, week after week, closing outside the box, that's a big red flag that says something's wrong. The market isn't pricing in the volatility. The ranges aren't reflecting the true volatility. Skewed models are up. Something is off because we're closing outside the box multiple weeks in a row, like we did here. That was a week where we closed on Friday out of the box, and the very next week, we did the same thing again. Or back here where we closed outside the box, and the next week, we did it again. That's 4. And if we're counting back, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. That's way too many closes outside the box. We use this for a warning that we don't want to do things like iron condor trades, those Friday expiration iron condor plays. We don't want to do those. We're going to get ran the heck over. Plus, the weekly range is still too wide for those weekly iron condor plays, those mechanical plays. And for me, it's also a warning not to do the butterfly plays where, we're putting on butterflies 3 days out on the different levels, the green line, the red line. Because price is breaking its expected move model. This is a reflection of volatility, which is important because if you go look at the VIX, it's really low. I had someone ask me yesterday, how can you say VIX is up or volatility is up when the VIX is so low? The VIX is just a representation of the trading activity within the SPX. I mean, that's not a perfect description, but it's the most simplistic way that I can get the point across that the VIX, it's just volume on the S&P. That's it. That's not representing true volatility. Volatility is the nerd word for movement. If you want to gauge how much volatility your particular market has, look at its movement. Is it exceeding its expected range continuously? Because if it is, then it's an elevated volatility. We're 1% above the 10-day So when we think about that question, have we moved too far, too fast? And are we owed or are we due a pullback, some mean reversion, linear regression? This says no. 1.5 is around the sweet spot. Right now, we're looking at just this year, right? From January all the way to now. And the average has been around 1.25, staying underneath 1.5. Let's just say it that way. We peaked above it once, but mostly we've been staying underneath 1.5. And if we look at the move that we got yesterday, right up into 1.5, and now a little bit of a pullback. Now on these pullbacks, it doesn't mean we go to 0, back to the 10. This means we pull back. We can just stay there, holding above that 10 nicely, like we did it all through May, basically, most of May, before we fell back. Looking at the 10-week, the sweet spot in here is above 2.75, less than 5. So we want to stay in that elevated zone, greater than 2. And really anything more than 4 is probably a little bit of a concern. But that's the area that we want to stay in. That's the sweet spot. And we're back in it. We're exactly where we should be. All right, nat gas is down almost 2% this morning, but it's still up nearly 8% over the last 5 days. So it's just giving back some gains. Gold and gold miners are down. They're continuing their descent. Over the last 5 days, gold is down 5.5 and miners are down 6.5. So they're just adding to the losses at this point. Uranium continuing the loss over the last 5 days is down 4%. It's down another 0.6% this morning. And for the things that are up, the FANGs are up more than 5.75%. And over the last 5 days, 8.65%. So they were basically already up, what, 2.5%. And now this morning they're up 6%. Feel that? Semiconductors, the FANG stocks, the VIX, oddly enough, semiconductors again. So we have this one, then we have this one. Both represent semiconductors, then just your generic tech. MAGS is another version of the MAG 7 and the China ADRs, but those need to move up just a little bit more because the benchmark or the cutoff is 0.5%. We're not quite there. They're up, just not up enough. So Tesla's up about $11 this morning. Apple's flat. Microsoft is down. Nvidia's up $2. And Netflix is down. So it really looks like Tesla is skewing the MAG 7 model, and that's why it's up so much. Meta's down. Baba and Baidu, really nothing there either. It's just Tesla. Tesla's pushing And NVIDIA is starting to push a little bit with that $2 move. On the news this morning, it was some talk about headquartering Tesla in Texas, and then Musk with the CEO. That whole fight about him getting paid seems like it's nearing a decision. I'm sure there's more to the news than that, but that's what they were talking about when it comes to Tesla. AVGO announced a stock split. This thing is crazy expensive, so it's good to hear. I think they're going to do a 10-to-1 just like NVIDIA did. This is one of the FANG names, by the way, if you haven't caught on to that yet. If you go look at the NY FANG ICE index, AVGO is one of the names on the list. I look at it at least once a week because those names can change. It took AMD's place on the list. So PPI, Yellen, and the 30-year bond are your three biggest events today. Tell you, I look at SMH here and it makes me think of an exhaustion gap, right? Where we expand again, and then get this last hurrah, little blow off top kind of exhaustion gap. If it is that, it should cut through the midpoint of yesterday's candle, but that's a really big candle. So maybe something like the 786 of that big candle. Let's bring that back to a bigger chart. All right, so here's SMH. There's another gap up that we're not seeing on Thinkorswim. Do a little trick here. Yeah, it looks like a daily now, but it's not a daily now. So this is what we have that we're talking about, this gap up here, and now the fade back. So one, getting back inside of yesterday's range, that'll be bearish. And then two, we want the midpoint of that candle. Breaking through that will be bearish. You have to be careful, though, when you get one of these plays, because it can just fall and then stabilize. This isn't a really good example because it didn't gap up very much, but it had a big move, had a recovery day where it tested that half back and it held and then gapped up. Looks like it probably opened, gapped up, had a run, and then dumped. One of those rug pull days where they yank it out from underneath you. It failed to hit 1.5 from the measured move. Now it's broke down. Got the 786 that we can use for like line in the sand on this pullback. And then, of course, we could just mark all of yesterday's range. So, yeah, they're up. but think that could line up into an exhaustion gap. NASDAQ looks a lot like that too, right? Now, tech, XLK, it didn't really even get that gap up. It didn't get outside of yesterday's range. China ADRs aren't looking all that good. Started with this really big gap up, got outside of yesterday's range, and then just collapsed right back in again. That tickles. Silver continuing to get that beat down. $26 is the line in the sand. That should hold. If it doesn't, then we'll look to retest 24. Yeah, crude. I forgot we were going to get on that too. So this is the range we've been playing in crude. It comes back to 2021 with this breakout. It's elevation through this range here for 2019, 2017. Just keep backing up. All right, so we get into these ranges or these zones, and then we get stuck in them. We've seen some pretty good moves, like in Valaro. But in crude, when you say energy, it's too broad, too vague, right? Energy can have solar and exploration, drilling. It's just a very vague concept, but narrow it down into crude. And this very likely is just a bit of a reflexive bounce, but we're in the middle of the zone. So not a good place to be thinking about a position. Against the high, against the low, not in the middle of nowhere. And for gold, I was looking at this yesterday. This has been trying to rally, but it's been a sell the rip all week. Multiple weeks, right? All month, I should have said. So just look at that beat down. Now, if you squint at this a little bit, there is a kind of a head and shoulders in there, but even just leave the squint out. Forget the head and shoulders for a moment. Focus on this really big candle from June 7. There's your half back rejection. We want to take it back to the zero, the bottom of this really big bar, and then see if we can break out of that with measured move, 2236. So Broadcom up almost 14% this morning. You know, at first blush, you probably think that's a short, but I would caution you against that. I wouldn't try to short it just because it's made a big move. And Tesla up more than 6%. This still looks like trash, so I would approach this with caution. And NVIDIA up 2%. Looks a lot like the exhaustion gap like we had here. Closed at the highs, opened, gapped up. It tried to do a little bit more of a run, and down it went. So we're up again this morning, 2%. Line in the sand, focus on yesterday's high. If we break through that, then focus on yesterday's close. See how far away that is from the midpoint. That'll be your next target, then yesterday's open, and then focus on this gap close. Now, different analysts do gap closes a different way. The key is consistency. So this isn't about right or wrong. It's just which way you want to go. For me, the market closed down here at 120.91. If I want to see this gap closed, price has to come back down to this point. Other analysts will just mark this candle and mark this gap and say, oh, there's a gap here. But if price comes back down and gets inside this candle in any way, the gap is closed. I'm not that kind of analyst. But it's not right or wrong. It's just being consistent. So if you consider that getting inside this candle is a gap close, then it's already closed. For me, this gap is not closed. It needs to come down to 120.91. So that's what I would be focused on. We're gapped up. Let's get back inside of yesterday's range, then through the close, then the half back, yesterday's open, yesterday's low, and then target 120.91. And that's if we get this exhaustion gap and price falls down. What could happen if we're going to stay bullish is that we fade back and bounce on yesterday's high as a support level and continue that move to the upside. We're getting a little bit in the pot stocks, but that's not very good yet. It's up 1%, so that makes it seem good. But when you come in and look at the intraday, look at the chart this morning, that's not very impressive. So watch the clock, look for a rising tide today, see if we can get more sectors to appreciate this move. 8:30, noon, and 1 o'clock. Pay particular attention to what Yellen says. She could have some influence on the 30-year today. I wouldn't expect it, but I mean, they're so close together. We could have a wild afternoon. Everybody be careful.